it's dropping. But is the fight really over? Today, we're diving deep into the latest consumer price index numbers, breaking down why the headlines might not tell the full story and exploring how tariffs could shake things up in the months ahead. The latest inflation numbers. All right, let's start with the big news. The Consumer Price Index, or CPI, inflation report for March dropped this past Thursday, April 10th, 2025, and it's got some surprises. Headline inflation, which tracks overall price changes, fell from 2.8% in February to 2.4% in March. That's a nice dip. Core inflation, which leaves out volatile stuff like food and gas, also eased from 3.1% to 2.8%. Now, these numbers are closer to the Federal Reserve's 2% target, so you might think, sweet, prices are calming down. But hold the thought, this is more like the calm before a storm. Why the drop? Energy prices are the MVP here. Year over year, energy costs are down 3.3%, and gasoline prices specifically tanked 6.3% in March alone. That's keeping overall inflation in check. But not everything's rosy. Shelter inflation, think rent and housing costs, is stuck at a stubborn 4%. Food inflation sitting at 3%, and some items are straight up painful. Eggs? Brace yourself, they're up a jaw-dropping 60% year over year. I mean, who's out here making omelets with gold? Butter's up 5.5%, coffee's up 6.7%, meats are up 4.6%, and milk's up 2.9%. So while the headline number looks tame, your grocery cart's still feeling the pinch. Why these numbers are deceptive? Now, before you get too excited about that 2.4% headline inflation, here's the catch. March's data barely includes the impact of some massive new tariffs that kicked in recently. We're talking 104% tariffs on Chinese goods, a universal 10% tariff on other countries, and specific ones on things like cars. These are game changers, and they're coming for prices soon. Think about it. When it costs more to import stuff like electronics, clothes, or car parts, businesses don't just eat those costs. They pass them on to you and me. So what looks like a win today could turn into a headache by summer. To give you a sense of the stakes, let's zoom out. Over the past few years, inflation's been a roller coaster. We hit crazy highs a couple of years ago, and now it's trending down, thanks to cheaper energy and some Fed moves we'll talk about later. But those egg prices and rent costs show inflation's still got some teeth, especially for essentials. And with tariffs looming, we need to understand what's driving this battle. Tariffs and their role in inflation. All right, let's talk tariffs. They're the big elephant in the room. Tariffs are basically taxes on imported goods, and the U.S. is going hard right now, especially on China. Federal Reserve Chair Jerome Powell recently weighed in, and he's not sugarcoating it. He says tariffs will likely cause inflation to spike, temporary spikes, he hopes. But here's the thing, it all depends on the details. What products get it? How high are the tariffs? How long do they last? And what happens if other countries, like China, clap back? Speaking of China, they're not sitting quietly. They've matched the U.S. with 125% tariffs on American goods, and it's basically a trade war standoff. This isn't just numbers, it's a global chess game. If China's exports get crushed, they might flood markets with cheap goods to offload inventory, which could keep some prices down temporarily. But long-term, higher costs for everyone, especially for stuff we import like tech or clothing. Now, Treasury Secretary Scott Bessent has a different take. He admits tariffs are inflationary but calls them a one-time price adjustment. Basically, he's saying prices might jump once, then settle. I'm not so sure about that. When you're talking 104% tariffs, that's not a one-and-done deal. It ripples through supply chains, from factories to store shelves. Then there's former President Trump, who's been vocal about tariffs. He claims his earlier tariffs brought in hundreds of billions without spiking inflation. There's some truth there, but let's break it down. Those tariffs pulled in about $25 billion a year, peanuts when the federal government spends $20 billion a day. They were smaller, targeted, and phased in slowly, so they didn't rock the boat much. Today's tariffs? Way bigger, way broader. Comparing them is like comparing a splash to a tsunami. The Federal Reserve's tough choice. So, where does the Federal Reserve fit into this mess? They're the ones steering the economy. Honestly, I don't envy the Fed. They're basically trying to juggle fireballs while walking a tightrope. Here's their dilemma. Cutting interest rates pumps up the economy and saves jobs, but it can also fuel inflation. Keeping rates high, or raising them, tames inflation but risks slowing everything down, maybe even tipping us into a recession. It's a lose-lose choice, and the Fed's own meeting notes admit they're bracing for difficult trade-offs if inflation sticks around while growth weakens. For now, it looks like they're prioritizing inflation over growth. Why? Fed officials like Powell and Governor Adriana Kugler keep hammering that 2% target. They're saying the economy and job market are still solid. No red flags there yet. But they're not expecting big inflation progress this year, which tells me they're nervous about those tariffs. Imagine you're the Fed. You see prices for eggs and rent already high, and now tariffs might jack up the cost of your TV or sneakers. You'd probably hit the brakes on rate cuts, too. Tariffs and your wallet. Let's make this real. How do tariffs actually affect you? Well, many of these new tariffs, like the 104% on China or the 10% universal ones, come with a grace period. Goods already on ships or in warehouses won't face the full hit until late April or May. There's even a rule for small Chinese imports under $800 that doesn't kick in until May 2nd. Sounds like a breather, right? Not quite. Retailers don't have to wait. They can raise prices whenever they want. So, that new phone or pair of jeans you're eyeing could cost more by next month, even if the tariff's not fully in effect. Here's a quick example. Say you're buying a $200 pair of sneakers made in China. A 104% tariff could add over $200 to the cost at the factory level. The retailer might not pass on the full hit, but even a $50 hike stings. Multiply that across your shopping list, electronics, clothes, car parts, and it adds up fast. By June, when tariffs are in full swing, we could see inflation creep back toward 3% or higher, especially if China's trade retaliation tightens global supply chains. What's China doing? Since we're talking tariffs, let's peek at China's side of the story. It matters for U.S. prices too. China's not just slapping on 125% tariffs to match the U.S., they're in full-on survival mode. They're restricting stock sales to prop up their markets, forcing companies like JD.com to spend billions buying unsold export goods, and begging countries like Spain and Vietnam to stay trade buddies. Why? They're staring down a trade decoupling with the U.S., and losing allies could tank their economy. This affects us because if China's exports crash, they might dump cheap goods globally, which could keep some prices low for a bit, like those $10 t-shirts. But if their economy wobbles, say, the yuan drops past 7.4 again, it could disrupt supply chains, making everything from iPhones to toys pricier here. It's a domino effect, and we're all in the game. Future of inflation. Looking ahead, the Federal Reserve's got two big meetings coming up, May 7th and June 18th. Before the March CPI report, there was an 83% chance they'd keep interest rates steady in May, no cuts. After the report, with inflation softer than expected, the odds of no cut dropped to 73.4%. That's a sliver of hope for a cut, but I wouldn't bet on it. By June, though, things get interesting. The chance of a rate cut jumps to 88%, thanks to that 2.4% CPI number. Markets are optimistic, but here's the rub. If tariffs start pushing prices up in April or May, that optimism could vanish. What could derail this? A few things. If retailers hike prices early, we'll see it in April's CPI. If China's trade moves backfire and global costs rise, that hits by summer. And if the Fed smells inflation picking up, they'll slam the brakes on cuts, keeping borrowing costs high. That means pricier loans, mortgages, and credit card bills for you and me.